So, friends, now that we have a financial plan coming into place, we're paying things off, we're getting our financial house in order. What about investing your money? Well, that's a big step for us. Again, we want to make sure our debts are paid off. We've got a cash flow plan going. Things are going up for us. This may take some time to get to this stage. Don't rush it. And when we get to this stage, keep it simple. That's the best advice here. When we start investing, we're thinking of at least 5 years for an investment and at least 6% return. Taxes and inflation can eat some of that up, so we have to have at least that to even call it an investment. In the world of finance, there's the risk and reward. It's the laws that are given here. The higher the risk, the greater the reward needs to be, as that cat contemplates that pelican, and possibly the pelican contemplating the cat for lunch. Whoever gets it is a high risk and is certainly a high reward there. So, in investment terms, there's this investment risk that you could lose it all. You may invest in a corporation, you may invest in a small business, a partnership, anything, and you could go broke. So, when we think about risk, we want to think about how can we reduce that risk. And that would be researching, consulting with experts in your field. The key to wisdom, according to Socrates, is to understand that you really know nothing. And from there, you can start gaining your wisdom. Understand what you do not already know. So, that's one way to do it. Research it. Put extra. If you're going to put your money in it, you should know exactly what it is you're dealing with. If you were to go out and buy a car, your first nice car that you really wanted, you would probably do a lot of research because you know what you want, and you would talk to other people about it. You get to find the best deal. And so the same thing here. What is what you need? So that's investment risk. Now, wait a second. You may be saying, hey, I don't like risk at all. I'm going to take all my money and put it under my bed. And maybe I have $5, $10, $20, $30,000. Well, it is safe from investment risk, okay? If it's hidden well, nobody's stolen it, all things being equal. But what about that inflation? We know inflation, prices are so expensive, and we've been hiding inflation under the rug, and now its ugly head is all over us. And just look at the price of everything. That $20,000 or $30,000 30 years ago probably doesn't buy. But does $30,000 in the year 2000 buy the same amount in the year 2020, in the 2020s, 2021 to 2030? No, absolutely not. So there is no risk, there's no reward, so there is the non-investment risk that inflation has taken that apart. Now, I think you always need some money at home. There's never a bad idea to have a couple $1,000s ready to go for an emergency fund. Okay, especially if a worldwide emergency, or if you got caught in a hurricane, or got caught in when power went out and banks could not open, you'd have some cash to operate with. Good idea. Liquidity. Liquidity is how fast can you get cash. So if you have your house, which is a huge investment, even in the fastest going rates today, you probably could not get cash real quickly out of a house. Okay, so cash in the cookie jar. It always, get that cash. It's very liquid cash in your bank account, but you're probably not risk. The more liquid an investment, the less amount of investment return you're going to get. So you do need liquidity. We've talked about that. Emergency fund should be very liquid. Once you're ready to go into investment, we got to get out of the cookie jar, we got to get out of bank accounts, and we got to see what the market will offer us. So as we look at bank accounts, they're very liquid, but they don't have a good interest rate anymore. Back in the day, my friends, in the great 80s and even 90s, you could get 7 to 8% in a good CD or money market, and that's how the middle class literally were able to build wealth so easily and very, very protectively, because they had federal insurance against that. There was no risk except just that you're going to be tied up with your money a little bit. At 2% interest by 72, you get 36 years to double. And now that we're even under 1%, it would just never double. So we cannot consider those investments as much as great places. We need bank accounts, need a savings and a debit always, okay, throughout your personal finance, throughout your career and your life. because obviously we're going to have direct deposits from work and things like that, and that's where our emergency fund could be because it's very, very liquid. But it's just not an investment anymore. Real estate, talked about this just a few minutes ago. Owning your home is possibly the best investment you'll ever make. Uh, Hopefully, okay. Of course, we talked about not buying more house than you can afford. Maybe use a 15-year mortgage if possible, because that pays it off faster, and you're not doubling your payment. You're just paying about an extra 115, and then you could do that if you are in a house right now, and you have a traditional 30-year loan. That's okay. Put an extra $100 a month. That could cut 6 to 10 years of time off that loan, and hundreds and thousands of dollars, maybe $10,000, $20,000, or maybe even more than that, with 100 extra a month. So, backbone of the financial plan right there. You could go and try to buy more real estate, but be careful. Be careful on that. You need to know what you're doing before you start flipping homes, because you could go broke real quick. Stock market, equity market. Now, we've talked about stock. Okay, you're part ownership of an organization, of a corporation, and we've really seen good rates of return. Of course, you could also lose everything. It could be overvalued, and of course, the stock could just go. The company could go belly up. If you just had everything in, say, one type of a stock, like just Tesla itself or just Apple, even though those are amazing companies, you may even deal into smaller companies that are up and coming, a lot of risk, a lot of potential return. But there's where your research comes in. There's where the research really comes in. And that's the single stocks. Again, single stocks can generate some really good return, 8% on a yearly basis. And the stock market itself, when you look at the indexes, may be generating somewhere around 10 to 12%, which we've been looking at over 10-year periods of time. If you look at the NASDAQ, the Dow, the Nikita, other Chicago markets, things like that. So how could we kind of diversify our risk? That's what we want to do. We want to, for keeping it simple, how can we just limit risk in the stock market, achieve a good rate of return? And I think you'll find that in mutual funds or ETFs, exchange traded funds, which are very close to a mutual fund. And these are giant organizations that buy, they pool their money from investors and buy a mix of stocks, bonds, securities. So instead of just putting in Tesla, maybe we have a Tesla, Apple, Amazon, Dillard's, American Express, MasterCard, Home Depot, Walmart, a lot of different industries, a lot of different sectors. The thinking here is that if the tech stocks went down hardcore, would other real estate funds go bad? Would retail go bad at the same time? If everything goes bad at once, then we're pretty much in a doomsday effect. That nothing's going to come back, and that's just not. I can say probably, very good chance that's just not going to happen. Where every sector of the economy goes terrifying. Now, COVID, you could say, certainly did a lot of crazy things. The stock market went down to 18,000, and here we are in the late 2021, going into 2022 and beyond. It's at 36,000. Will the stock market bubble? Probably. It is bubbled. It probably pops, and it's just going to come back up, I would think, because money's got to go somewhere. It's going into equities and real estate. So, this is the nice way a mutual fund will diversify your risk and get you that nice rate of return. 5 years in a mutual fund investment. If you're thinking about getting that house, and I think I'll invest in mutual funds for the next 5 years, that may or may not be a good idea. More than likely, may not. If you need to accumulate money to buy a big purchase, then just put it in the bank account. Just hoard up your money as hard as you can. This is for long term. You'll want to use mutual funds, in my opinion. Again, we're keeping it simple. You may be a stock trader. I had a student that had over 10 years ago in my class. I saw her the other day. It was great to meet her again. She was on campus with some of her family. And she says, you know what? I started investing in stocks just because of the course you taught. And I did a lot of research, and I played the market for the last 10 years. And she's told me how well she has done, and she has done very, very, very well to a six-figure income. And loving every bit of it. So that's a very aggressive, high risk, but she's mitigated the risk because she does a lot of research. So for the rest of us, I think mutual funds will be an excellent investment, especially when you start working and you have a 401k or a 403b. That's going to be retirement. Or you get into individual retirement arrangements or individual retirement accounts, IRAs. And those are boxes that you put your investments in. And mutual funds will be a very good investment, more than likely for that, because they can range from 8 to 25% over the life of their funds. So they can go the ups and downs. You keep that money in there, especially in your retirement accounts, and let it roll, my friends. Different types of mutual funds. There's large cap, which means large capitalization. These are funds that only invest in the biggest companies in the world, so their stable growth and returns, probably low risk, but a good steady rate of return. You may get that 8 to 10%. There's the mid cap, which are companies that have come out of their growth stage and are accumulating, lots of cash at this point. They're probably up to $25 billion in assets and a little bit more risk, and you get a better return. And of course, there's small caps that are, or real new startups that can be a roller coaster, very aggressive, but they get you high rates of return. There's sector funds, oil funds, energy funds, the solar powered funds, international equity. Friends, this is where you do your research. You can go on a lot of places. Fidelity Investments is in our backyard. They're in Westlake. And so you can get on the Fidelity website and just go mutual fund research and look what their portfolios are, look at their expense rates, and that could really, really set you up right there with good knowledge. So when you start investing, you can do that now before you invest, you'll know what fund that you would like to get into. And so when you do start that type of investment, again, I think the high-grade mutual funds will set you up for the majority of your investments. You could put 25% into each, because generally speaking, when you're in an IRA or a 401k, which we're going to talk about here in a second, you get to put in what type of funds you want. So you can put 25% into large cap, mid cap, another 25% international, natural resources. You're diversifying among diversity. And with that type of structure, I think you probably get that 12%. And remember, that's every 6 years, money's doubling. And you do that when you are young and you have the money to do it, okay? You're not in crazy debt. You're in that investment stage of the financial plan that you have extra money to do this. Can really, really set you up in life to where when you are in your 50s and 60s, you can really look at a good retirement and doing something else with your life. We don't jump to that step. Warren Buffett, I don't try to jump giant jumps here. I look for 1 foot bars I can just step over. I look for what's a really good investment, and probably nobody else researches like Warren Buffett and his team at Berkshire Hathaway. They really research their companies tremendously. And again, those are some of the funds you could buy into as well. Berkshire Hathaway stocks. They're very expensive. I think they're over $100,000 on some of his series stock. So keep it simple. Get your financial house in order. Kiss that money. High quality mutual funds, do that research. We're looking at 5 and 6%. Remember those automatic transfers. All right, once you get in, and there's some really good apps out there called the Acorns app and the Robinhood app where you can do this on your phone, and they're letting small investors really jump in at this point. And feel free to ask me about those, and I can get you that information, how to get into that, because again, putting in 20, 30, 50 bucks a week, let that run, and you could do some great stuff. As we look at the last part of this class, we're completing up that financial plan. Again, my friends, I hope this is interesting, and if you really want what we call to get the flesh of this, take my BUSI 1307 course. Here's your retirement. More than likely, probably 95% of the time, maybe even 100%, 99%, you'll be offered a defined contribution plan, which is what we call a 401k or a 403b. 403b is the nonprofit world. These are cash accumulations where maybe your employer matches your contribution, but part of your paycheck can go into these funds. Think of them as a big box that you're putting investments in. The defined benefit plan, which my father had, and my mother still enjoys that even though she's in assisted living, that's basically the pension, where you work so many years in an institution, usually 25, 30. I mean, you have to stay there a long time, but they will give you somewhere between 70 to 90% of your average salaries, usually the 4 highest salaries, for life, as long as you live, and then you can also choose a surviving spouse benefit for your spouse if you were to pass on, but at least your spouse would have something. And that saved my mom, literally. Thanks, Dad. So here we are, the defined contribution plan. So this is as much as you put in. So if you got a 401k, all right, 403b, these are accumulations. So it's a box, and in that box, think of it that way, you're able to utilize those mutual fund investments. And so you look at the company who's doing your 401k, and you say, okay, great, I want, maybe it's Fidelity, maybe it's Vanguard, there's a lot of companies out there, but I want an aggressive fund if you're very young, and maybe you'll hit 4 different type of investments, mutual fund investments. They also have money markets, they have real estate trusts. Usually you could get, there's a lot of different variety. And that's what we want. We want at least 2 to 4 different varieties. You can also, depends if it's a 401k and it's a private company, you could use your company's own stock for your retirement. You could use a little bit of that. Just be careful, because your company would love for that to happen, because that just gives them more capitalization, all right? That gives them more funding. So basically, you are purchasing that stock, and that stock is going in the box of your 401k. Now, the only thing is, you say, well, man, I got a great company I work for. I'm doing good. Okay, cool. But you haven't really diversified your risk. You are dependent upon that company for your current income, and now you're putting everything in your retirement account in that same company. And that can be very dangerous. Look up Enron and see how those people did. Most people lost their entire retirement thinking it was worth $1 million, and a day later, Enron had done so many fraudulent accounting practices that their stock was worth nothing, and their $958,000 401k was $2,000 the next day. Crazy. Be careful. Use the mutual funds. 4 types that we discussed. Always contribute to match your company. Let's just say you got an amazing company, and they're going to say, "We tell you what, we'll match 50% of your contributions to $10,000." Now, you can't put all your money into 401k. It's usually a percentage, like 7% of your salary. So let's say they do that. That means you put in 10, they put in 5. Sweet. So now you got 15,000 in there. See if your company matches. And most companies are doing that now. They stopped during the Great Recession of 2007 to 2011-ish. Hopefully most are back. And so if you don't, think of it philosophically. Let's say you only put $1,000 in. Okay, well, they'll put in 500, which basically means you just gave that company $4,500 back in return. Yeah. You need to always go to the match, my friends. Max out, and you're in good shape. That's free money. Get it. Now, here's something. Let's say you got $1 million in your 401k, and then you retire. Can you outlive that money? Well, you can if you live a long time and you spend that money without a plan. So you can outspend that. You can outlive and outspend that account real quick. So you have to be. That's why you need these financial principles in your life. Now, if you do get a defined benefit plan, that may be for a very large company. What it is, it's income streams based upon your working income. So they give you percentage. So let's just say you made 70. So someone's basically going to retire, and their average salary was 75 grand, and they had 80% of that. So they get a $60,000 income stream for life. That's nice, isn't it? So in theory, you cannot outlive that type of plan, because if the beneficiary dies and has not elected a surviving spouse benefit, then the money stops. But they always have that money in their retirement. It's like a paycheck every week. Most companies stopped that because it's very, very, very expensive, and people started living longer, and all of a sudden they lived 20 years. Well, that's $1.2 million right there they paid out when they thought maybe they'd only live 5 or 6 years. I mean, these are actuarial tables, my friends. They get this down to a science. And of course, they also had health benefits with that too. So basically, they had a $60,000 job in retirement. Again, if you are fortunate enough to get that and you work with the company a very long time, then you also do some extra investing. But that's a great thing to have, the old pension. Now, what about an IRA? These are things you do on your own. They're called individual retirement accounts. Again, think of them as a box that you put your investment in. The traditional IRA is tax deferred. So You can put up to $5,000-ish a year. I think it's a little more than that, but let's just say 5,000. Okay, and so if you make $50,000 a year, and all of a sudden you look at your gross income, automatically you get to take $5,000 off because of the traditional IRA. Now, when you utilize it, you with IRAs and retirement, you just can't get it anytime you want to. You got to be 58, 59 years old to start using it. And so in a traditional IRA, if you do take it out early, you take a big penalty, and we don't want those penalties. I mean, they're like 50% with the taxes and the extra penalty on there. So when you use it at 58, 59, now it's ordinary income. So was your pension retirement. I mean, that was just an extra income for you. And you have to start withdrawing by 70 years old. Now, do you need a traditional IRA? In my opinion, I would get one always, because let's say you job hop. You have 5 different career companies you work for in your career. What happens when you leave? Well, the 401k may very well be in that company's plan. Could be the company may be managing it. You can always roll that directly over to a traditional IRA and not have any tax implications. And then you can utilize your investment strategy. Again, 1307, we'll talk all about that. So that's the traditional IRA. It's really nice. Now here's the Roth. The Roth is amazing. You don't get any tax deferral. So if you put $5,000 in, you make $50,000. You don't get to take $5,000 off of your income and get taxed at a little bit lower rate for the Roth. But you do get this. That is tax-free for life. So in both IRAs, the money is generating tax-free while it's in the IRA. When you go to withdraw from it, in the traditional one, it's ordinary income. Now you're paying you're paying your basic tax on that. So you take out 10 grand, you're taxed whatever tax rate you're at. The Roth IRA, you wait till you're 58, you've been contributing to it, you take it out, it's tax-free. You can gift it very easy to your beneficiaries. The Roth is fantastic, my friends. The government has tried to shut this down for about 20 some odd years. They haven't. This is the one you definitely need to get. This is where you will use all those strategies that we use for those mutual funds. Get the Roth. Again, you can do this in your Acorns account, and other apps that are out there that are very good. I'm happy to show you those. Come by my office. This is great. Even if you do a traditional Fidelity fund, there is no maximum age for withdrawals, which means you can gift it right to somebody else. And the income limit is if you're single, you can't make over $100,000 and contribute to a Roth. If you're married, you cannot make over $200,000. You have to do the traditional IRA. And again, the Roth is just amazing. It's one of the few things that you can get tax-free for life. So again, up to $5,000 a year. You're single. You are ready to invest. That's what Rory and Randy in that earlier example of putting that money in. That's where we put it in those Roth IRAs, and you could get up to $1 million or $2 million throughout your lifetime by doing that, even more. So I can't say enough about the Roth. If you are in the income levels, do it. It is fantastic. Insurance, excuse me. Purpose for having insurance is limit risk. You can never, ever not have a risk. And virtually no. You don't have enough money that you never need insurance. In fact, the wealthiest people have lots of insurance to protect their wealth. Absolutely. And so you got to find the right amount. Insurance people will sell you a lot of insurance that you may never use. So again, get the right amount of insurance that doesn't make you broke. Your emergency fund is the insurance on your financial plan. When you have a fully funded emergency fund, you got $10,000, $20,000, $30,000, start raising the deductibles of your own insurance. This means you don't go robbing your investments when something bad happens. You've got the money. So it's fantastic. Health insurance. Friends, you got to have it. If you are, do the what was called Obamacare. I don't know if it's still called that, the Affordable Insurance Act, 2010 or something. But I've had so many students that get hurt on the job without insurance, or they go out with some friends and get food poisoning. This one student I did, and she was in such anxiety all the time. and their ER bills were huge. Hey, a hospital, once, you know, they'll charge you for everything. Without insurance, you have no one negotiating on your behalf. And so you have these huge numbers that you have to pay. And if you don't make a payment within a few months, they turn it over to collections. And now you are in Dante's definitely fifth level of hell, and maybe even the eighth level, which is treachery. I mean, it's bad. It's bad. Have some insurance. If you get in that situation, go right to the hospital's charity desk. I'm a college student. I don't have anything. I need help, and do it fast. You've got to do it before it goes to collections. I've just seen too many students wait too long, and there's really, you're going to have legal help if that even does anything. So get some health insurance, even if it's major medical. Major medical just pays for the up to $1 million policy of not well at visits, like your physicals and things like that. It's just for catastrophic. Also, once you start your job and you're offered long-term disability, sometimes you get it immediately. Long-term care disability is insurance on your income. Absolutely, it is. And it can cover, if you were to be disabled and can't work, basically it covers 60% of your current income for the disability to about age 60, 65 till retirement. You don't want to know what Social Security will pay you. Social Security pay you maybe $900 a month for disability. That's SSI. Yeah, that's not going to do anything. Unfortunately, under the age of 60, you have 80% chance of being disabled versus death, which means you need it. So if you are self-employed, it's worth it. And usually when you sign up on your benefits on that great first job that has your career job, this is why, it's good to have all those benefits. Get it. Don't say, I don't need that. I'm young. I'm good. Get it. Life insurance. The average cost of a funeral is 10 grand. All right. I know some people who can do it better than that, and I've had to use them for family members. So what you really need, to make it super simple in life insurance, 20-year level term, 8 to 10 times your income. If you're making $40,000, you need $400,000 worth of insurance. This pretty much takes care of your family. But wait a second, I'm single. Hey, right now, if you're in your 20s, even 30s, you can get 20-year level term. They're very low rates right now. They've been that way for about 10 years. So you may be able to get a couple $100,000 for $8 a month or $15 a month. Get it, because that will go all the way to your 50 if you're 30 or 40 something, and then you level it up again. You want to use your most insurance when you are in your prime working area, and you have family, of course. So your family is taken care of, your children are taken care of. Once they're out of the house, they have their own jobs. Once you have a lot of things paid off, you should not need as much insurance as you think you do. I said term. Be very careful of whole life or universal life, because they're marketed as investments. They're really not, and they're very expensive ways to insure. And once someone needs their death benefit, they don't get to keep the cash value. It's either the death benefit or the cash value. It's a mess. It's kind of a scam, really. So, yeah, there's your insurance right there. 10 times, 8, 10 times, you'll be in good shape. Automobile, that'd be nice to drive right there. That's a Porsche Cayman. You need the gap insurance. Most of you are probably going to finance a car. If you finance a car, get the gap. The gap is between what the car is worth and what you owe. It only lasts for a few years, but you don't want to get in a wreck and you owe $25,000 on the car, and then your insurance says, well, that car's really worth 20. All of a sudden, where's that $5,000 coming from? You make up the difference. The gap insurance will help make up that difference. Most all of it, if not all. Okay, got to buy it, I believe, the time that you purchase your car. Again, a good emergency fund will always help that, my friends. It's one of the best insurances against the financial plan. Long-term care. Hey, I've dealt with it with my parents, with my wife's parents as well. 3 years in a nursing home. Think of this maybe for your parents, your grandparents. Long-term care is insurance against your total assets. We've probably paid $1.2 million of my father's estate. It's almost all liquidated to his health and the health care of my mother. And they thought that long-term care insurance would be just too expensive. Many of the people who were in the long-term care, and she knew them throughout their lives, their children told me, oh, we're good because they bought long-term care insurance. They were able to get that. And so they get to keep all their assets, and it's very painful. It's about $70,000 a year, just a basic amount to keep somebody in a long-term care facility. So for you guys, I'd say purchase it in your 60s or 65 years old, or have a plan. If that's me, there I am. It might not just dump me in and don't let me come out. And I say that tongue in cheek, but it's a tough way to live in long-term care as well. And have that talk with your parents, have that talk with your grandparents, because it can really take away everything that you ever worked for. These are insurances to avoid just because they don't pay out well and they're very expensive. They're just very expensive. A good 20-year level term, your long-term care, your long-term disability, they're two different ones right there. That should really be the ones that you want to look at in life. If you're over 18 or older, you need a traditional will. And I do have some websites on our class site that you can go get those. The will, a traditional will, is the only thing that can speak for you when you're dead. Nothing else can. Not the best intentions, not your parents. I mean, basically, if you don't have a will, you die what is called intestate, and then that means the state has to determine who gets anything that you have. And if you've done some financial planning, you may have some sizable assets. Think about that with your parents. Think about it with yourself. Again, who's my executor, and who gets anything that I have? You can do these online. I believe uslegalforms.com, and or a lawyer will draw one up for about $500. I mean, they got to make something, of course. It's about as cheap as you'll ever pay with a lawyer. But it does make sense, my friends. 70% of Americans die without a will. The artist Prince, great artist of the 1980s and musical artist, of course, died without a will, and he had a very sizable estate. Man, I tell you what, if you don't like somebody in your family, die without a will, and they've got to take care of all the messes. I could go into many stories, and they're all unpleasant. So take care of that, my friends. Always nice for you, your loved ones, and again, this is information you share right here. Called the I Love You list, and that is basically, hey, here's the phone numbers. I bought some life insurance. Here's the account number. I'm going over that with my mom right now and make sure the beneficiaries are up to date, because the beneficiary for my mother's policy was my dad, who died 17 years ago. So you can guess who the beneficiary is now, but there we go. So your life insurance, IRA, investments, retirement, credit cards, hey, funeral arrangements, all those, put that in a simple list, update it once every few years. Say, if I die, don't cry. I know you're going to. Don't mourn right now. Here's all the stuff you need to go to. And of course, I would also say, if you're single and you have all your own information, certainly banking information, you may want a parent or someone to have access to your bank account, which means they could actually, they're listed as a person on the bank account. My next door neighbor passed away, and I deal with her brother-in-law on a weekly basis because he comes over and talks, and he said everything, she had nobody on the account. So the bank doesn't even care about a death certificate. They've locked it up. We can't pay her bills. They're paying all of her bills out of their own account, and it's gonna come out okay. But it would be so much easier if someone else would have been on that account to just keep the house payment, everything rolling. It has to go through probate. The wills always will, and that's a little funny thing there. But traditional will goes through the probate, and it takes about a month, and then you can start going. Then the executor can execute the will. But if you had somebody on there, and again, as maybe a son or daughter, and it's just your own accounts, and they're getting sizable, you may want someone else just to be on there. That way, they could easily gain access, and it's just business as usual until everything is done versus being locked up. And it's amazing how fast banks find information. They can lock it up real fast when they find out that someone has died. But if someone else on the account, it's good. Little something right there. Take everything, go on Amazon, go to Walmart, buy yourself a nice little box right there, fireproof, waterproof safe. Put your birth certificates, investments, licenses, everything in there, and say, hey, if anything happens to me, the combination's 007, get into it, and I think we'll be in good shape, because it is a living hell for those who did not do this, and they are the loved ones, and they've got to go through all of this, and it's terrible. It's terrible. So I hope that really does help you. Make sure you graduate. You're going to make so much money. You know, stacks on stacks. Remember, all my great tutelage, I get 3%. Okay, after the first 3 years, I'll give you 3 years to get warmed up. Then you pay me 3% of your gross sales. All right, for all the wonderful information you learn in this course. Keep that degree, get it, because you're going to make much more money with it. What if you're debt free? What if you have 20 grand in the bank and everything's being funded well? You could probably do some different things in life, certainly when you get to different stages. Get some nice financial freedom. Never, ever, ever give up. Best advice from the greatest leader of the 20th century, Winston Churchill. Saved the country from World War II, and that was his speech. He said, hey, just never ever give up, and just sat down, and he got a standing ovation from that. This is hard. Getting your finances in order is not easy, and it may take a lot of blood, sweat, and tears, but it's worth it. The alternative is broke, and this is going to be worth it, my friend. It's going to be worth it. Boom. I just dropped the mic. I hope you take at least one idea from this class and you can apply it to your daily life. Remember me on WebAdvisor, your evaluations, and if you didn't like this class, then forget me on that. Also, ratemyprofessor.com. The other courses I teach that you can take are Marketing 1311, and of course, my favorite, BioSci 1307, Personal Finance. My friends, it's been a fast semester. I've enjoyed every bit of it. I hope you have too. I wish you nothing but great success in your lives.